Okay.
Okay.
Now let's go to the fourth paper. Benjamin, nice to have you here.
Yeah, thank you
Uh,
very much.
Please,
Okay.
can you briefly introduce yourself, and
Okay.
you can start your session. Thank you.
Okay. Okay. Let me share my screen
That's
and then
fine.
I'll introduce myself. Yes.
And you started recording yourself as well. That's good.
Yes, yes, yes. My name is Benjamin Miba'am. I'm a student, a PhD student, PhD candidate in the Department of Economics, Faculty of Business and Economics. This paper I'm presenting is titled "Do Uncertainty and Risks in the United States Impact This Bitcoin Returns?" Uh, I'm under the supervision of Professor Hassan Gungu. So I'm going to present now. Hello? Okay. So the introduction, global financial crisis of 2007 to 2009 came with many uncertainties, thereby altering the conventional strategy that financial experts and financial market investors adopt to channel their resources for investment, diversification of risks, and hedging facilities. It has succeeded in heightening economic uncertainties and escalating worldwide doubt in the financial market. And because of the global financial crisis, Bitcoin came into being after a person or a group of persons known as Satoshi Nakamoto published a seminal paper on Bitcoin. And since then, Bitcoin has continued to grow in all leaps and bounds. Although many people predicted that Bitcoin is going to end, Bitcoin in particular and cryptocurrencies are going to fail, just like some other similar innovations before them ended. But Bitcoin is still gaining trust and acceptance among individuals, especially young computer enthusiasts, fintech companies, and firms with online transactions. And the major reason why Bitcoin has continued to defy the dooms that have been predicted is because it is decentralized. It means it occurs, exists outside the control, of government or institutions that are affiliated to the government, like the central banks and other financial institutions. So Bitcoin has continued to elicit a lot of attention from researchers, and it has been looked at from different dimensions. Some people look at it as a speculative asset. Others look at Bitcoin, as an investment, as a safe haven for investment. There are those who see it as, a hedging instrument, during economic uncertainties, while others look at it, as a hedging instrument for geopolitical risks, and the rest of those. Others maintain that it is an alternative currency. It is now evident that shocks generated as a result of policy uncertainty and risks have impact on financial market. That is, the financial market is continually integrated, has continually integrate other external factors into it. For instance, things that happen, such as economic policy uncertainties in some regions can affect the financial market in other regions or even worldwide. So the literature on Bitcoin currently is linked to the inevitable economic policy uncertainty and geopolitical risks. So while geopolitical risks can affect financial markets by encouraging investors to move their investment from traditional financial market to cryptocurrency market, Bitcoin is linked to economic policy uncertainty through its safe haven properties and hedging abilities. By way of expatiation, EPU, that's economic policy uncertainty, and financial markets are increasingly interlinked. Economic policy uncertainty is an index that is generated by Baker, Bloom, and Davis, and they use some top papers. I think top 10 papers in the United States to generate the indices for economic policy uncertainty by using some particular, by generating some particular words within those newspapers. And then the geopolitical risk is also an index that has been generated by Caldera and Icovelo, and it's also looking at relationship between or among countries that usually impact the financial sector either negatively or positively. As we are going to see, economic policy uncertainty, has to do with things like, election, things like unemployment, and so on and so forth. While geopolitical risks has to do with, like I said, relationship between or among countries. Example of some of the geopolitical risks include, the U.S.-China, trade relationship, U.S.-Russia international relationship, the war in Ukraine, the South China Sea tension, the crisis in Israel, and between Israel and Palestine, and so on and so forth. So the aim of this research basically is to first of all determine or to test the hypothesis on the hedging and safe haven ability of Bitcoin during uncertainty periods. And also, the study aims to test the direction of relationship on the relationship between economic policy uncertainty and Bitcoin returns, between geopolitical risks and Bitcoin returns, and between political risks and Bitcoin return.
Benjamin,
This study.
I would recommend to speed up a little bit.
Okay. So
You're
let me
seeing
go straight.
introduction.
Sorry. Okay. The literature review. A lot of people wrote on the relationship between Bitcoin return and economic policy uncertainty, and Bitcoin return, geopolitical risks, and then other people also combine economic policy uncertainty and geopolitical risks and their relationship with Bitcoin returns. But this study actually introduced an innovation by using three different variables. That's the economic policy uncertainty, geopolitical risks, and political risks, to ascertain the relationship of those variables with Bitcoin returns. So there are several scholars that wrote in that regard, and the method they use, the case study, the variables they use, and their findings. Like I've summarized it in the table. So for the method, the data that this study employed is monthly data for the analysis, the dependable variable being the return on Bitcoin that is computed using the natural logarithm of the ratio of two consecutive observations. By using this, we were able to generate the Bitcoin returns. And then we employed the EPU, that's Economic Policy Uncertainty Index, generated by Baker, and then the Geopolitical Risk Index that was generated by Caldera and Icovelo. Then the political risks was sourced from the International Country Risk Guide and the PRS group. Those are the three. Then we also use some control variables, which include the gold prices, S&P 500 volatility index, and the Euro US exchange rate. The data for the study is strictly determined by the availability of data, which ranges from August 2010 to March 2022, making it to consist of 140 observations. And the availability of Bitcoin prices depicted the starting months, while the last month was determined by the availability of political risks in the US. So description and correlation metrics. We have the description and correlation metrics here, which I won't be able to explain because of time constraint. These are the this is figure one, and it's the figure that consists of the variables that have been used for the study. You can see we have Bitcoin returns, we have the natural log of EPU in the US, natural log of GPR in the US, natural log of political risk in the US, the gold S&P 500 volatility index, the Euro US dollar relationship are all there. And then I will have to say this quickly, because of the way the variables are behaving, we tested for unit root test. That's the Zivot Andrews unit root test for structural break, because especially the Bitcoin returns shows the likeliness of structural break. Therefore, we tested for it. And then this is the result for the Zivot Andrews structural test and the respective results that we got. So for the Bitcoin returns, we're able to get the structural break at December, 2023. Yeah, so we divided the study into the full period, then the first sub period, and then the second sub period. Some of the analysis will be in that regard. So in order to test for unit root, we use the augmented Dickey-Fuller and the Filiferon unit root test. And as can be seen in the table.
4 minutes. You have 4 minutes left.
Oh, okay. As can be seen in the table, all the variables were integrated.
You can skip the stationarity.
Okay.
Methodology
Okay.
as well. You already explained the variables.
Yes. So the results, this is the result that we're able to get, the OLS result, because we use three different methods, the OLS, the ARDL, and the quantile regression. So, and this is the OLS result, which shows that, the EPU has basically positive relationship, while the geopolitical risks and political risks have negative relationship, sometimes significantly, other times not very significant. And the ARDL, autoregressive distributive lag, for the full period shows that the EPU, and all the variables are not statistically significant. For the first sample period, the result shows that all the variables are not statistically significant, but the correction term, is according to expectation, according to that priori expectation. And then also the ARDL result also shows that all the variables, the major variables, the independent variables are not statistically significant. So given the area result indicates that the problem of heteroscedasticity for a full sample period, the need for the use of quantile regression is justified. And that is why we now use the quantile regression. And the quantile regression, we use tau to be 0.5, and we divided the study period to the full period, the first sub period, and then the second sub period. And generally, the result shows that the EPU is statistically significant in the full period at the middle quantile, while all the variables are not statistically, all the major independent variables are not statistically significant across all the quantiles for the first subperiod, while the second subperiod shows that economic policy uncertainty is statistically significant at the lower quantile, at the bottom quantile, and political risk is also statistically significant at the lower quantile. The other control variables are significant at the lower and then the middle quantile. So, sorry, I was going backwards. Let me go forwards. So our main result revealed that EPU US, GPR US, and PR US are predictive of Bitcoin returns. It's an indication that the hedging ability and the safe haven hypothesis, holds for uncertainty and risks. The OLS result also, supports that. It shows that only EPU, US, but weekly towards GPR and PR in the US. The finding aligns with Wu et al. 2019, but contradicts Cologne 2021. Similarly, the overall ARDL shows that Bitcoin returns is a weak hedge against EPU, GRP, and PR across all the periods. The finding aligns with that of Boari et al., Boari 2017b, 2017c, and Wu et al. The quantile regression result indicates that hedging ability of Bitcoin return towards EPU is more intense in the middle quantile for the full sample period, which roughly coincides with the significant rising price of Bitcoin in the 2016-2017 period, while geopolitical risk exert weak influence on Bitcoin returns in all quantiles. PR, that's political risk, only showed a strong relationship with Bitcoin return in the lower quantile. Overall, the result indicates EPU and Bitcoin returns are positive related, indicating that investors move their investment from conventional financial assets to Bitcoin during periods of economic policy uncertainty to avoid the risk of losing their investment. This finding is in line with Gosgor and Mokni.
Can you finalize the presentation, please?
Okay, in conclusion, the empirical results.
Very straight to the point, please.
Okay, yeah. So in conclusion, our result shows that economic policy uncertainty is positively related to Bitcoin returns, while geopolitical risks and political risks are negatively related to Bitcoin return. Among the variables, the economic policy uncertainty, hedges more and plays a role of safe haven than geopolitical risks and political risks. And therefore, the study recommends that investors should consider more of economic policy uncertainty than geopolitical risks and political risks when they are making their market analysis for investment purposes. The novelty of this study is the innovation of broadening the risk variable by introducing political risk index in investigating the relationship between uncertainty and Bitcoin market. The future research can focus on the relationship between uncertainty and Bitcoin volatility by segregating the risk variable into international risk factor in the form of geopolitical risks and national risk factor in the form of political risks. So with this, I've come to the end of my presentation. I hope you'll be able to pick one or two things out of it. Thank you.
Thank you for your interesting presentation. Good luck with your PhD study. Okay, we got
Thank you very much.
2 minutes for questions for Benjamin. Any questions? No questions? Come on, guys. All right, then I have to move to the next,
Okay.
what do you call? I have to move to the next paper. Thanks a lot, Benjamin. All right.
Thank you very much, Prof. Yeah.
Can you stop sharing the screen, please? I see me. Okay, thank you. All right, we have Mustafa. You joined late a little bit, Mustafa. So you have